options trading. The only place where you can turn $100 into $10,000 or $100 into zero, often within the same week. We need to talk about leverage, because somewhere between genius and gambling, options trading has become the most seductive and most dangerous game in retail finance. Here's what's actually happening under the hood. When you buy an option, you're not buying a stock, you're buying the times, right? Times to buy or sell a stock at a specific price. And that right expires like milk, like a parking meter, like your patience watching the market bleed red on a Monday morning. It sounds sophisticated, it feels sophisticated, and that's exactly the problem. The early 2010s were wild retail traders started waking up to options like they discovered fire, and financial Twitter was basically one long highlight reel of life-changing returns. Then came 2020 and zero-day expiration options, Wall Street bets. And suddenly your dentist was talking about call spreads. But here's where the mood shifts. Studies consistently show that roughly 80 to 90% of options expire worthless, which means the house in this case, the market makers wins most of the time. Yet the promise of turning a $500 bet into $50,000 keeps people coming back like a slot machine with a Bloomberg terminal aesthetic. The psychological trap is real. You see one viral screenshot of a 10-bagger, and suddenly your brain rewires itself around the exception, not the rule. Nobel Prize-winning economist Daniel Kahneman spent a career explaining this exact bias. And yet, here we all are, refreshing our brokerage apps at 6:45 in the morning. Here's the historical truth though. Volatility in options markets isn't new, and every generation thinks their crash or their squeeze is uniquely catastrophic. The GameStop squeeze of 2021, the dot-com blowups of $2,000, the portfolio margin disasters of $2,000 8 different decades. Same human behavior, same Greek letters on the screen. Options fit neatly into a cycle of financial innovation, followed by retail adoption, followed by retail destruction. And that cycle is older than the Chicago Board Options Exchange itself, which opened in 1973. The community wisdom that has quietly survived is simple. The traders still standing are almost never the ones swinging the hardest. Let's kill a misconception right now. Options are not inherently riskier than stocks. They're just times differently, times risky. And used correctly, they can actually times reduce times portfolio risk through hedging. The danger isn't the instrument, it's the position size, the leverage ratio, and the complete absence of a plan when things go sideways. So what do you actually do with this information? History says, define your risk before you enter. Never risk more than you're emotionally prepared to watch. Go to zero and treat each trade as a process decision, not a conviction bet. The traders who survived multiple cycles weren't smarter. They were more disciplined, more boring, and frankly, a little less fun at parties. The practical framework is almost anticlimactic in its simplicity. Start small, use spreads to cap your downside, avoid earnings plays until you understand implied volatility crush, and write down your exit plan before you open a position. Boring is a strategy, and consistency over time compounds in ways that no single lucky trade ever could. There's something almost philosophical about options. They force you to think in probabilities, not certainties, which is actually a healthier relationship with uncertainty than most people have in real life. The market doesn't care about your conviction. It cares about price, time, and volatility. And humility about that fact is genuinely protective. And here's the irony that keeps the whole thing spinning. The traders who approach options with the most caution, the smallest size, and the clearest process are usually the ones who end up with the most optionality. Pun completely intended. Discipline, sizing, and consistency aren't the sexy parts of the story, but they're the only parts that actually have a sequel. Whether the market rips higher or collapses into a correction, a well-sized, well-planned option strategy can be positioned to benefit from either outcome. And that kind of rational preparation is the closest thing to peace of mind this game offers. You don't have to predict the future. You just have to survive long enough to participate in it. And if you're ready to put that same disciplined thinking to work in other areas, whether it's real estate investing, home contracting, or connecting with the right lenders, check out our links in the description below, and let's build something together.